In a previous module, we talked about the goal of financial management as being to maximize the wealth of the owners or the shareholders of a firm. We also said that the maximization of shareholder wealth was equivalent to maximizing the value of the corporation. There is a third way in which we can state this objective: the maximization of the corporation's share price. We can see the equivalence between this and the other two statements of the goal of financial management. Obviously, the higher the share price, the wealthier shareholders, and the value of the corporation is simply the number of shares multiplied by the share price. We also talked in a previous module about the three different kinds of companies: private companies, public companies, and listed public companies. These three types of companies differ from each other in terms of how the share price can be established. In the case of a private company, there are a limited number of shareholders and there is no market for the shares. Shares in private companies rarely change hands. In the case of a public company, the public at large is invited to buy shares, but once again, there is no organized market and shares in public companies are rarely traded. By definition, the shares in a listed public company are listed on a stock exchange, which means that there is an organized market to enable the buying and selling of shares. Only in this situation can we say that there is a market in which the true value of the share price can be determined. A capital market is a market in which financial assets are traded. In any capital market, including the share market, there are two kinds of markets: the primary market and the secondary market. The primary share market is the market in which shares are first created, when the issuer of the shares creates the shares and sells them to the public. This is the only market in which funds from the sale of shares flow to the issuer of the shares. An example of a primary market transaction is an initial public offer. We'll talk more about that in a moment. A secondary market is a market in which shares are bought and sold after they have been created in the primary market. Funds from buying and selling shares in the secondary market are transferred between investors. No funds flow to the issuer of the shares. The main example of the secondary market for shares is the stock exchange, and we'll talk more about stock exchanges later in this module and also in the next one. There are three main ways in which shares can be sold in the primary market. In a public offer, the public at large are invited to subscribe for shares. So an initial public offer is just one kind of public offer. It is a public offer whereby a company is trying to become listed on the stock exchange for the first time. The stock exchange requires companies to have a certain number of shareholders and a certain amount of issued capital. So the initial public offer is designed to meet the listing requirements of the stock exchange. There can be subsequent public offers when companies try to raise additional capital by selling shares to the public. The company or the investment bank organising the offer on behalf of the company needs to advertise to potential investors, prepare a prospectus, which is a lengthy detailed document telling investors all about the company and the offer, and they need to process applications from the public at large. The advantage of a public offer is that a large amount of capital can be raised. An alternative is a private placement. Under a private placement, shares are offered to one or a small number of large investors, for example, superannuation funds. The advantage of a private placement is that it is much quicker than a public offer and much less expensive. One of the disadvantages is that shares need to be sold at a discounted price. The potential investor won't pay the current market price because they could just as easily buy shares at that price on the stock exchange. So shares need to be sold at a discount in order to attract the investor. Another disadvantage is that it results in the dilution of the ownership of the existing shareholders. Because new shares have been created and sold to a new investor, the existing shareholders own less of the firm than they did before. A third method is a rights issue. Under a rights issue, existing shareholders are invited to apply for new shares. A rights issue may or may not be renounceable. If it is renounceable, then a shareholder who doesn't want to buy new shares under the rights issue can sell their rights to somebody else who can then buy shares under the rights issue. Under a non-renounceable rights issue, if a shareholder does not take up the right to buy new shares, then those rights are forfeited. Under a rights issue, there is no dilution of the ownership of existing shareholders if they buy new shares under the rights issue, or, if the issue is renounceable, sell their rights. If they cannot sell their rights and they choose not to buy new shares, then they will own less of the firm than they did before. As we discussed earlier, trading in the secondary market is done via the stock exchange. The stock exchange provides a liquid market for investors to buy and sell shares. The word liquid means investments can easily be turned into cash at a price which reflects their fair value. And this will only happen if there are many buyers and sellers willing to trade at prices just above or just below the current market price. The other thing that a stock exchange does is that it's a mechanism to establish the market price or the fair price of the shares through the forces of supply and demand. We said earlier that funds from the sale of shares in the secondary market do not flow through to the issuer of the shares. But there are still advantages for the issuer of the shares from the fact that the stock exchange exists. Investors are more likely to buy shares in the primary market if there is a market for them to sell their shares afterwards. And a mechanism for establishing the market price of shares is also of advantage to the issuer of the shares. An increasing share price is an indicator that management is doing its job well in increasing the value of the firm and the wealth of shareholders.